And now, without further ado, it's Compliance Update, featuring Letter 226J, the Employee Mandate Strikes Back, with your hosts, Dan Cooperstein and Dot Summers.
Hi, and welcome to Compliance Update. I'm Dan Cooperstein.
And I'm Dot Summers.
Dot and I are happy to be with you here today in 2019. Still, hard to say that, still, getting used to that. Starting our new Compliance Update show and webinar, presenting live from scenic Camden, New Jersey, in front of a real studio audience. We're so excited about our brand new show, where we're going to share with you the really important health and welfare benefits compliance news, discuss the impact of these developments with government officials and Washington, D.C. decision makers, and of course poke fun at some of the funny things they do without getting political, of course, because, well, that's just not what the show is about. But just as some background on me and Dot, Dot and I work together at Corporate Synergies, overseeing the national benefits consulting practice, helping clients out in all aspects of employee benefits compliance matters. Dot brings over 20 years of experience in benefits to our team and is really the brains behind the operation. I bring over 10 years of experience practicing as a lawyer in employee benefits and executive compensation matters, including experience assisting clients of all shapes and sizes with DOL, IRS, and other governmental audits of their benefit plans.
So basically you're saying I'm the brains of the operation and you have no sense of humor at all.
Pretty much, yeah. I guess that's one way to look at it. I mean, at least I like to think of myself as amusing. But in any event, we're going to try to have some fun here today with the compliance news. And so let's go ahead and get started. So it's nice to be back here, like I said, in beautiful Camden. And as you may know, the federal government took a month off between December and January. And guess what that means? Dot and I also got to relax and go on vacation too, as there was absolutely nothing for us to do.
I wish that was true. Unfortunately, we were busier than ever preparing this presentation and reviewing the Letter 226Js for our clients and helping them with their response letters. Exactly.
Yes, that was obviously just kidding. And seriously, as we weren't off along with the government. We did spend some time preparing for this presentation a little bit. And one of the big goals for each show is to present the benefits compliance news for the last few months. The other big goal we have for each show is to go in depth on a particular topic each show. And today we are choosing the Employer Mandate Strikes Back as our in-depth topic. But first, the news. And just as a quick disclaimer, we're going to go through all of these news items more briefly than we've done in the past because we have a lot to cover. And you can always email us after the show if you want to learn more. So I'll go ahead and get it started. This is just sort of a list on this slide and the next slide of just all of the things that really happened over the last few months. So, Dot, which news item do you think I should start with first? The HRA guidance or the contraceptive coverage mandate? Which one sounds like more fun?
I think it's a tough call. Both seem like a pretty good blast to talk about. But let's start with the HRA guidance.
Great. Sure, let's start with the HRA guidance. So on October 29th, 2018, the IRS, DOL, and HHS jointly issued proposed regulations that would allow for two new types of HRAs, individual coverage HRAs, or ICHRAs, and limited accepted benefits HRAs, or LIRAs. The newly proposed ICHRAs could be integrated with and could be used to reimburse premiums for individual health insurance coverage if certain conditions are met. Employees and dependents covered by an ICHRA would have to be enrolled in individual coverage, and an attestation or other verification of enrollment would be required when their participation starts and when expenses are reimbursed. Among other conditions, like the ICHRA would have to be offered on the same terms and conditions to all employees within a class, except that the benefit amount could increase by age or by family size. The other type of newly proposed HRA under these new proposed rules is called the Limited Accepted Benefits HRA, or LIRA. The LIRAs would allow employers to offer non-integrated HRAs that qualify as accepted benefits and therefore would not be subject to certain ACA mandates. The new LIRAs would have to meet very specific requirements, however, including, among other requirements, a requirement that the employer would have to offer other non-accepted, non-account-based major medical coverage to the LIRA participants, and a requirement that not more than $1,800 be available to each participant per plan year. Notably, a LIRA would not be allowed to be offered to employees who are also offered an ICHRA.
Hey, Dan, hold on here a minute. You're throwing out a whole bunch of acronyms: LIRA, ICHRA. Ooh, not good. So let's So basically what you're saying here is that the new proposed rules allow employers to reimburse premiums for individual coverage, something that wasn't allowed under the ACA and actually specifically prohibited under the ACA?
Exactly. Yep. That's exactly what I'm saying. Thank you. Yep.
Well, then why didn't you just say that?
I object.
Really? You object? You know what? Maybe you are funny, and I've been always wanting to say this to you. Overruled, Dan. Overruled. Please move on.
Okay, I'll move on. Another significant part of the new proposed rules is that opting out of an ICRA would render an employee ineligible for a premium tax credit on an exchange.
Wow, that's a really big deal, since that would mean that the employers would not be subject to an ACA employer mandate penalty on behalf of those employees who were ever to go on the exchange.
Exactly, right. That's right. And while we're going to talk more about that later in our ACA employer mandate refresher session later in the program, we should also mention that new guidance recently came out from the IRS that explains how these newly proposed rules would work with the ACA's employer mandate and about how the rules would work with the requirements of Section 105H of the Internal Revenue Code, which are non-discrimination testing requirements applicable to self-insured plans. One other thing to note is that even though these rules have not been finalized, they are slated to go into effect for plan years beginning on or after January 1 of 2020.
Okay, let's talk about the birth control mandate next, Dan.
Sure, let's do that. In other news, on January 14th, 2019, a Pennsylvania federal district court judge issued a nationwide preliminary injunction blocking two recently issued sets of final regulations that had allowed for broader exemptions to the ACA's birth control mandate. The judge's decision came one day after a district judge in California also issued a preliminary injunction halting the same ACA regulations from taking effect in 13 states and the District of Columbia. The new final ACA regulations, which were issued jointly by the DOL, HHS, and the Treasury, would have allowed employers to invoke either religious or moral objections to avoid the ACA's birth control mandate, which requires that employers offer contraceptive coverage at no cost to employees participating in their health plan. And those final regulations were scheduled to go into effect on January 14th of 2019.
So basically, with all that said, you're basically saying that the new rules never really went into effect.
Exactly.
So then if you're an employer with religious convictions, you have to go back and follow the old rules that existed during the Obama administration.
Exactly. Yeah.
Wow. Always fun times with the government,
yep.
Isn't it?
Yeah, fun topic. Definitely a fun topic. So let's move on. On November 29th, 2018, the IRS released Notice 2018-94, which explains the deadline for furnishing the 2018 Forms 1095-C and B to employees. It explains that it's been delayed until the furnishing deadline has been delayed until March 4th of 2019. The original deadline was January 31st of 2019. The notice does not, however, extend the deadline for filing the forms with the IRS. In addition, the notice extends the good faith transition relief from 2017 to 2018. And while the notice came earlier than expected, it was almost exactly the same notice that we got last year. They just keep doing that. They keep extending the deadline for furnishing and extending the good faith relief every year. It's, it's kind of like deja vu, like that movie with the annoying insurance salesman from hell, Ned Ryerson, Ned the Head.
You mean the movie Groundhog Day with Bill Murray?
Yes, Groundhog Day. That's it.
Wait a minute. You remember the name of the salesman, not even the star of the show, and not even the name of the movie?
Yeah, so?
All right, let's move on, Dan.
All right, well, on December 10th, 2018, the IRS released interim guidance in Notice 2018-99, clarifying the tax treatment of qualified parking benefits and other qualified transportation fringe benefits under the Tax Cuts and Jobs Act, commonly referred to as tax reform. The new notice is focused on explaining how to calculate the amounts of the loss of deduction for, and likewise the UBIT tax that arises from these employer-provided qualified parking fringe benefits. The IRS also issued Notice 2018-100, which provides tax relief to nonprofit employers that had underpaid estimated income tax as a result of recent changes to the federal tax treatment of these benefits. And in particular, the new 21% UBIT tax that the tax reform law placed on nonprofit entities. While the new guidance was certainly helpful to both for-profit and nonprofit employers alike. One thing that was puzzling to nonprofit employers was that the new guidance did not expressly indicate one way or the other whether the new 21% federal UBIT applicable to employer-provided transportation benefits also applies to the employee's salary reduction amounts, like through salary reduction agreements that are used to pay for such transportation benefits. While most nonprofits are currently paying the new UBIT on those salary reduction amounts, the IRS has never clarified their position on that, and that 21% tax can be a very big cost, and particularly when that nonprofit entity is also in a state that has its own tax code that mirrors the federal tax code, and therefore in those states an additional UBIT may be added on top of the 21% federal UBIT. And one of those states, until recently, was New York, which had added a 9% UBIT on top of the new 21% federal UBIT. So on that note, on the very same day that this federal tax reform guidance was released, December 10th, New York Governor Andrew Cuomo signed legislation to provide tax relief to nonprofit employers by decoupling or disconnecting the New York State tax code from the same provision of the federal tax code that, under tax reform, had applied the UBIT to nonprofit employers.
So basically what you're saying is that prior to the law going into effect, New York was imposing an additional 9% on top of the already 21% that the federal government was imposing for those nonprofits?
Exactly.
Well, at least that's good news for New York State.
Yeah, definitely really good news. So, okay, good. So let's move on to talk about another big development that happened with the EEOC, consistent with a court order that had vacated the wellness plan incentive provisions of the EEOC's final wellness regulations under the ADA and GINA. The EEOC decided recently to issue final rules that would remove these incentive provisions from the regulations. The removal, effective January 1st of 2019, leaves sponsors of wellness plans in something of a legal vacuum when it comes to plan design. As background, that federal trial court had determined in 2017 that the EEOC had failed to justify its conclusions that a 30% maximum incentive was a reasonable interpretation of the voluntariness standard under the ADA, among other problems that the court found with those rules. Well, one published government report has indicated that the EEOC intends to issue new wellness incentive regulations in June of 2019. In the meantime, employers with wellness programs have to decide what to do with their wellness incentives until the new rules are released.
Yep, and that's right. And to put that in plain English as opposed to lawyer speak, Dan, that means that employers still need to follow the HIPAA wellness incentive rules, which are still in effect, as well as other laws and regulations that still affect your wellness plans. That's
right. Thanks, Dot. And in another very big news, December 14th, a federal district court judge in Texas, in the case of Texas v. U.S., ruled that the Affordable Care Act is unconstitutional. The court reasoned that because the individual mandate provision of the ACA is unconstitutional due to the fact that its tax penalty was eliminated under tax reform, and because that individual mandate is inseparable or inseparable from the rest of the ACA, the entire ACA must be invalidated.
And if everyone remembers when this issue came up way back in the summer of 2012, when the Supreme Court upheld the ACA on grounds that it was constitutional, because the individual mandate was in fact a tax and not a penalty.
That's right. And while this decision was surprising to many, including us, the White House and the Department of Health and Human Services subsequently reached out to the public and stated that the ACA will remain the law of the land until a final decision has been reached. And then subsequently a stay was granted in the case on December 30th, which means that the ACA is still in effect for all 50 states. So that means that there will be no changes to the ACA until the Texas decision has been reviewed by the U.S. Court of Appeals for the Fifth Circuit and most likely the U.S. Supreme Court, and which also fortunately means for Dot and myself that this will not be our last show.
Good news.
Exactly.
Not last and not first.
Exactly. Close call, right? So notably, one of the more interesting things about this case, in the case, the U.S. Department of Justice, arguing on behalf of the Trump administration and the federal government, had argued vigorously in their brief that the ACA's pre-existing conditions rule should be invalidated and held unconstitutional since it was inseparable from the ACA's individual mandate. Shortly after the judge made his decision in the case on December 14th, President Trump tweeted that we need to keep the pre-existing conditions rule. Other government officials, including CMS Administrator Seema Verma, reminded everyone enrolling in the exchanges that their coverage would be available and that the decision was not the end of the road for the ACA. In other news, the federal government shutdown that occurred last month had a very big impact on employee benefit plan compliance, delaying the 2019 ERISA plan limits release until January 23rd, and also delaying enforcement of round 2 of the ACA's employer mandate. In another big development, a recent U.S. 8th Circuit Court of Appeals decision in the case of Peterson versus United Health Group weighed in on a practice for recovering health plan overpayments known as cross-plan offsetting. As background, generally plan offsetting occurs when, on occasion, group health plans sometimes mistakenly pay the wrong amount to doctors, clinics, and other providers, and when the amount paid is more than what the plan allows, that's considered to be an overpayment. And then the plan generally has to be made whole. So in order to do that, plan administrators often try to recover the overpayment from the provider. But if the provider refuses to return it, the plan often authorizes the administrator to recover the overpayment by offsetting it against future payments owed by the same plan to the same provider.
So in other words, shorting the payment owed to that same provider to cover for times when the plan overpaid that provider.
Exactly. And then cross-plan offsetting, on the other hand, occurs where a third-party administrator with multiple clients collects the overpayment by offsetting it against another plan's bills from the same provider. If the amount of the offset is credited back to the first plan, then both plans, the provider and the affected participants, can be made whole. So because this practice can sometimes result in a participant that's on the offsetting plan being left short or holding the bag, so to speak, the DOL has said that it doesn't like this practice. And in the recent 8th Circuit decision, the court held that cross-plan offsetting was questionable since it concluded that the practice was not authorized by the plan. But, however, since it concluded that the practice was not authorized by the plan in that particular case before the court, it didn't actually make a decision on the specific plan in that case with whether or not cross-plan offsetting was legal or not. But as a result of this case, plan sponsors are left without a clear understanding on the legality of the practice. But if you look at the court's remarks in the decision, it strongly suggests that at some point in the future, this practice may become unlawful.
So while we might have to wait for another day on whether the practice of cross-plan offsetting is legal or not, if you're a plan sponsor, you may want to review your agreements with your TPA and review your plan document to see how these address the practice or whether it is addressed at all. And if it's allowed, then your organization should determine whether it's worthwhile to keep this practice in the plan.
Exactly. And for our last update of the day, we just wanted to briefly touch on 2 proposed rules that came out recently on prescription drugs. On January 24th, 2019, CMS issued a new rule proposing that issuers be permitted to exclude drug manufacturer coupons for prescription brand drugs that have a generic equivalent from counting toward patients' annual limit on cost sharing. Currently, the amount that patients save using drug manufacturer coupons goes toward their annual cost sharing maximum. Additionally, on January 31st, HHS and the Office of Inspector General announced a proposed rule which would eliminate certain drug rebates to PBMs and encourage direct discounts for participants that are enrolled in certain government-funded plans, including Medicare Part D plans and Medicaid managed care plans. While these new rules are very preliminary and subject to comment periods, we will continue to report on them and keep you updated on future developments.
So just to confirm, we don't have to do anything differently just yet.
That's right. We're just letting you know what's coming down the regulatory pipeline.
Perfect.
Great. So let's talk about today's deep dive topic, the 226J and the employer mandate. And we call this section of the presentation the employer mandate strikes back because beginning in late 2018, we started to see the second round of employer mandate penalties being sent out to plan sponsors. And that is those penalties that are being assessed for that are being assessed for the 2016 calendar year. And these penalties came in the form of an IRS penalty letter called the Letter 226J, hence the name of our presentation for today. The first round, or first strike, of penalties under the mandate began in late 2017 for penalties that were being assessed for the first year of ACA mandate compliance in 2015. So we're now in round 2. But first, before we discuss that, we're going to provide a quick refresher on how the Affordable Care Act's employer mandate works. And we're going to make this quick, since we know that many of you are tired of hearing about healthcare reform and the reform of healthcare reform, which was a topic that we discussed endlessly back in 2017. So put your time machine hats on, and let's all go back to a much friendlier time, a time before 2015, when the employer mandate rules were first being released, and a time when all of these people could be in a room and together and smiling at each other. A time when the most unlikely things were still possible. So Dot, why don't you get us started talking about the ACA employer mandate and just kind of giving us the refresher.
Great. So, the things that Dan said, we are going to, as we go through this refresher, we're going to be using the 2018 numbers. They have increased for 2019. I may throw those in there as well. So the important things that we just have to understand is, why is an employer receiving these letters? So what we're going to really go through is what is required for employers, what are the penalties for noncompliance with the ACA's employer mandate, and how that compliance is reported, and how that does affect the employer and the reason why they may be receiving this letter 226J. So just as a very high level, I know you guys have heard this many times, but the basis of the employer mandate is that that there are two possible penalties. So the first penalty being the subsection A, or what we call the big penalty, and that is if an employer does not offer coverage, minimum essential coverage, to at least 95% of their full-time employees and their dependents, and at least one person goes to an exchange and receives a tax credit. In that situation, then the employer who does not offer at least 95% is subject to a penalty on their full population of full-time employees, minus a few 30 employees, but we'll talk about that as well. And then if an employer, though, does offer 95% minimum essential coverage to their employees, but they do not also offer minimum value and affordable coverage, the employer could then be subject to what we call the subsection B penalty, which is an employee-by-employee penalty. So that penalty is based on, as individual employees go to the exchange for those individuals that were not offered coverage. If an employer has 3 employees that go to the exchange, then they're only subject to a penalty for those 3 individuals. So just to summarize, what does an employer have to do? So again, employer must, 1, offer minimum essential coverage to 95% of its full-time employees. It also then, once that is met, they must also meet minimum value. Minimum value is an actuarial determination just based on the amount that the employee is paying in co-pays, deductibles, and coinsurance. There is a 40% threshold there. And then the final piece, once minimum and essential and minimum value is offered, you need to determine, is the coverage affordable to the employee. All right. So real quickly, how do we determine if coverage is affordable? Is it based on all plan types? Is it based on all tiers? No. So basically, when an employer offers more than one plan, with several tiers, the ACA is only looking at the single rate of the lowest cost plan that the employer offers. So if an employer has a single plus one, a family tier, when evaluating affordability, you're simply looking at the single rate of your lowest cost plan. And the ACA, for the premium tax credit, the rules state that you're using household income to evaluate that affordability, but because that's difficult for the employers to know employer household income, household numbers, they did allow 3 safe harbors for the determination of affordability. So the first affordability is W-2 wages. This is primarily used for salaried employees. This is looking at box 1 of the W-2. So box 1 is gross wages minus any pre-tax deductions. The second type of affordability the employer can use is a rate of pay test. This is usually used for hourly employees because it's easier to evaluate and determine what the employee is going to be working. Unlike the W-2, if you have an hourly employee whose hours are fluctuating through the year, you're not going to have a consistent prediction on what that person's income is going to be. So the rate of pay is basically taking the hourly rate times 130 hours, regardless of however many hours they work. And then the final affordability safe harbor is the federal poverty line. This is the easiest. It's the lowest amount that you can probably offer. And I say easiest is because it's a set amount each year. They set it based on the 100 or 100% of the federal poverty line. So if you have, your commissioned employees or your lower paid employees, you may want to set your affordability based on that. And just real quick for the affordability, for 2018, it is 9.56% of all of those things, and then moving into 2019, it's going up to 9.86%. And we kind of talked about this. These are the two penalties. Again, the A penalty, if you didn't offer coverage to at least 95% of your full-time employees, you can be subject to a full year of $23.20 per year, or on a monthly basis, $193.33, multiplied by the number of full-time employees the employer has in excess of 30. And this big penalty is if one individual who was not offered minimum essential coverage goes to the exchange and receives a premium tax credit. But, let's say you've done that. You're offering coverage to 95.1% of your full-time employees. You still have a population of full-time employees that aren't receiving minimum essential coverage. But since you met the threshold, you'll be fined for the A penalty. But you can also be subject to a B penalty for those individuals who did not receive coverage, and that is under the B penalty. And on a monthly basis, that is $290 per month, multiplied by the number of full-time employees, each employee who obtains a premium tax credit.
Right, and the reason why we're using 2018 numbers is just because we know that those are probably the ones that are fresh in your mind as you complete the ACA information reporting for 2018 now. For a lot of employers, it's now. These are the penalties that would go into effect if that's not done correctly or you didn't make the offer of the right amount of coverage.
Okay, great. So now we know everything that you have to do, and you're in compliance, but how does the IRS find out whether you did or did not do what you were supposed to? So that is done, as Dan said, through that information reporting. I'm sure everybody's going through that now. Everybody is in the process of completing those forms. So there are the two different forms. There is a 1094C form, which is where the employer completes information about their company, whether they're a part of a control group, how many forms of the 1095Cs they sent out. And this is the form where you report, did you or did you not offer coverage, minimum essential coverage, to 95% of your full-time employees. Then on the 1095C is where you're going to be reporting information about to avoid the subsection B penalty. So on the 1095C, this is where you're reporting, you're basically setting a story. For each month of the calendar year, did you offer coverage that met the requirements? Was the plan affordable? Did the person enroll in coverage? Was the person in a limited non-assessment period? And then also just to mention that if you are a fully insured plan, the insurance carriers will be using B forms, so they will be providing your employees a 1095B for compliance, again, with the individual mandate.
Great, and I think it's important that now as we start our employer mandate strikes back section of the presentation, I think it's just important to briefly mention here that almost everyone messed up a little bit in the first 2 years of mandatory compliance. And while most of our experience comes from assisting new clients that didn't have the benefit of all of our training programs on ACA compliance and the employer mandate rules and their reporting requirements, and all the other things that we've done, and because all those new rules came out so quickly and all their reporting requirements and everything else, and the transition relief, not to mention, it was really just too much information for most employers to fully comprehend when all of this went into effect back in 2015. That being, accordingly, almost every organization, even those with teams of in-house lawyers, made at least some mistakes. And so while we talk about our experiences helping clients through this process, we're definitely not trying to single anyone out. We're definitely not going to mention any names. We're trying just to make everyone aware of the fact that almost everyone kind of dropped the ball a little bit in those first 2 years. And since the problems were all over the board, this is definitely not trying to make anyone feel uncomfortable. Dot, as well as me, both know that definitely there was someone, somewhere, maybe sitting somewhere far in a far galaxy, far, far away, maybe even in the dark recesses of the Death Star. They were laughing about all the new excise tax revenue that was coming in from this thing. So why don't you get us started and talk about what the forms look like?
Great, thanks. And before I do that, I just wanted to mention too, and Dan has said, that there could be some mistakes that were made, and the question that we do get a lot is, with these letters is, well, why am I receiving this letter? I thought there was this good faith effort under the information reporting. I did to the best of my ability. We completed the forms as best as we could. We submitted those to the IRS. Why am I receiving one of these letters now? Well, unfortunately, the good faith effort only falls to the submission of the forms. It has another effect in the fact that even though you did your good faith effort, if there was still an error, something was left blank, something was incorrect, that could lead the IRS to believe that you didn't do what you were supposed to, then that's why you're receiving these letters. So it's definitely one of those confusing, and I definitely agree. Someone is laughing at us way, way, way far away.
Yeah, it is a clarification. I mean, so the good faith penalty relief that applies to the reporting only applies to the penalties that apply to the reporting, not to these penalties which apply to the actual employer mandate itself, right, which is the substantive requirements of like what you had to offer and the level of coverage. And those have another letter assigned to them, not the letter 226J. So, it's not, that good faith penalty relief is kind of a very, very limited penalty relief exception.
Right. Okay, so let's take a look and see what these letters look like and what you would be expecting from if you were to receive this. So, definitely an official letter. It's going to have the IRS's information at the top. This is the letter 226J. This is going to be your introduction to the penalty. It's going to explain really and summarize what I just did about the A penalty, the B penalty, did you offer minimum essential coverage, and that you are receiving this penalty. Now, probably the most important thing, absolutely to read through it, but the number one thing you want to look at when you receive these letters is the top right-hand corner of that letter, because there is the date there that it was sent to you, the tax year, but even more importantly is at the very bottom is your response date. That response date is 30 days to respond to that. So, the IRS is really essentially giving the employer 30 days to review, gather all their information, and make a determination and send this letter in. The second page of the letter 226J is called the ESRP Summary, Employer Shared Responsibility Penalty Summary, and this is going to explain to you on a month-by-month basis whether you're being penalized for the A penalty, the large penalty for not offering coverage to 95% of your employees, or the B penalty. So it's going to tell you month by month how many people you're being penalized for, the amount of that penalty, and then important to understand, again, whether it was that A, the big penalty, or the B penalty.
And conveniently, they add it up for you all at the end in the bottom right of the chart and tell you what the total is, so it's nice to have.
Yeah. All right, so now you've received one of these letters. Third page of the letter will be, this is your response page, and this is form 14764. And this provides basically demographic, it's contact information. So this is where you're going to respond to the IRS with the detail, which Dan is going to go on explain in a little bit, but this is where you say, yes, I agree, no, I don't agree, or, you know what, I sort of agree. So there is the ability to say, you know what, no, I completely disagree with this, and please see our documentation. Or, you know what, I do agree with it, I'm going to sign, I'm going to give my contact information, and I'm going to send in a check for the penalty letter. But in some cases, which we've seen, it's kind of a mixture of that, where you know what, yeah, we didn't offer what we were supposed to, but we're not subject to the A penalty, but we may be subject to the B penalty. So, you know what, we do agree that a penalty should be imposed, just not a $700,000 penalty, maybe a $10,000 penalty. And, you know, very important that you give detail on who they could contact at the employer. And it really should be, you know, someone, it's not just your CFO because this looks like a tax penalty. It really should be somebody who can explain and understand what happened. And then the final form, which is the 14765, this is two things. This tells you who the individuals were that received a premium tax credit and therefore is causing you to have the penalty. It will list the employees. It will list them by month, which months these individuals are causing you to be subject to a penalty. If there is a month where you will see no PTC, what that means is that the employee did not receive a premium tax credit for that in that month, so you're not being penalized for that month. So in addition to being a summary of who and what is causing you to be subject to a penalty, this form also requires a response from you. So in situations where maybe you left line 16 blank instead of filling in an affordability safe harbor code, so what they want you to do here is to correct that. So if a specific person's form was incorrect, it was left blank, and you know what, no, the person actually enrolled in the coverage, so we need to indicate that. You're actually going to handwrite that on this form and submit that with the rest of the packet.
And I think that's a really important point about this. A question that we commonly get is, well, you know, do we have to also send in our corrected ACA information returns with this letter 226J? And the answer is no, because the IRS is giving you that opportunity here on this form that's in the 226J packet. So that kind of gives you a sort of convenient way to show the IRS what you should have done that you didn't do in your reporting. Now, that being said, you should always, as soon as you discover a mistake that you made, that your organization may have made on a Form 1094C or a 1095C, you should always correct that reporting as soon as possible with a corrected filing with the IRS of the ACA information reporting forms. But this, as part of this process of responding to letter 226J, the IRS has said it's not required for you to resubmit your forms with the 226J response. So I guess I'll talk a little bit. I wanted to also just kind of address some of the common reasons for why organizations and employers receive the letter 226J. And again, going back to what I said before, right, this is just a lot of the things that we've kind of heard from some of the newer clients and prospects that we've met with as being sort of the common reasons. And just it's one of those things where everyone kind of messed up a little bit, so we're not trying to point anyone out or make anyone feel uncomfortable here, but we did see these are kind of the things that we saw. One of the big things that happened was that employers were seeing on their forms that somehow they don't know how, whether it was a software glitch or otherwise. On the 1094C, they had reported that no, they checked a box that said no, they did not offer coverage to 95% of their full-time employees. And that was like an easy sort of low-hanging fruit for the IRS, that, okay, a penalty, big penalty, let's get those penalties out for those people. And so those were some of the first ones that we saw in the first round or first strike of the employer mandate. And then when the employer mandate struck back, we continue to see this problem in the second year as well. So definitely something the IRS checks for early. And then the other big thing that we saw was leaving line 16 blank. And we don't know really why this kept happening over and over again, but we think that what was out there was that there may have been either software glitches by some of the payroll company vendors that were doing this, or just it could have been some of it was just the employer just didn't understand the importance of line 16 on the Form 1095C. But it's very important that you don't leave line 16 on the Form 1095C blank, because that is where you insert what's called your affordability safe harbor code or Series 2 code. And that's where you need to indicate, okay, well, this employee wasn't a full-time employee, this employee was in a waiting period or, or something else. That's where you put that code in. And that's also one of the first things the IRS was checking for on 1095Cs and assessing penalties for.
And also, too, I think there was some misunderstanding in the initial instructions for 2015, because they did mention that this line 16 is optional, that it doesn't necessarily have to be filled out, which is true, but you wouldn't fill it out if you want to be subject to a penalty. So it is an optional field, because if you didn't do what you were supposed to, you're supposed to leave it blank. But I know some vendors and some different entities that we talked to kind of took that as optional. It isn't really a big deal.
It's kind of like waving a big flag saying, IRS, penalty, send me a penalty letter, send me a 226J, because they looked for that right away. But yeah, definitely a common issue. The other thing that we saw that was common was not understanding, the other two things that were quite common were not understanding or misusing Code 2D. And Code 2D, it has this very fancy, and I think they were just confused about the terminology, because the reporting instructions talk about what's called a limited non-assessment period, or LNP, which is very like fancy legalese talk for basically when an employee is in a waiting period, right, or a measurement period, right, and so therefore you don't have to offer them coverage. But a lot of employers didn't really know how to use that Code 2D, so they were trying to report on what was offered during that or what was not offered, and they got penalties for that. And the other big thing was that some employers, some applicable large employers that were subject to the ACA were handing out Forms 1095-C to all of their employees, even part-time employees who did not need to get a 1095-C. I mean, these were for, unless they were, of course, on a self-insured plan and those people were enrolled, but that's a different story. This was a common issue with employers who sponsored a fully insured plan, and they were handing out those 1095-Cs to all part-time employees, and then the IRS would get something, would get a filed Form 1095-C on behalf of a part-time employee and would think that person should have been a full-time employee, and then when that person was not being offered coverage, then they sent out the letter 226J. So that was another common thing that happened as well. The other two big things that we saw, of course, the second one was more common than the third, were just software glitches, right? Issues with payroll companies, technology vendors trying to get into the space, and like we said before, so many rules came out so quickly, transition relief rules and everything else, that they didn't have time to change the software in time to, even in 2016, right? They were still making mistakes like this in 2016, so in the second strike as well. And then the third one is not as common, but obviously it still happened, right, where just the employers just messed up, right? They just said, well, we didn't offer the coverage, right? The coverage wasn't good enough, right? And so you could always just get one of those every once in a while as well, so not as common. So what should you do first, right? If your organization gets one of these letters, you do not need to roll. You do not need to stop, drop, and roll. You're not on fire. You don't need to yell go running into your finance department's office screaming at the top of your lungs. It's not that important, but you should stop, determine, and recount or retell your story, which are the three steps that we would advise our clients. First of all, when we say stop, we would recommend that you stop and take a quick look at everything that you did in the particular compliance year in question, right? So if it's 2016, right, what was the coverage that you offered in 2016? What does your SBC say? What does your SPD say? What does your plan document say? What, if you have an agreement with a carrier, what does that say? What did you actually do? What did the enrollment look like? Who waived, right? Try to figure that out as quickly as you can. And then since you only have that 30-day period that Dot mentioned earlier, right, you may need to get an extension. And so that should be kind of really as part of this sort of stop and look at everything really quick stage, right? Determine if you need to get an extension. Is one of the first things you do. And then the more serious the second stage is, okay, now that we have a little bit of time, let's really try to focus in on making the determination as to whether or not we did what was required and calculating what that penalty should have really been in actuality. And then the third part of the process is to really sort of recount or retell your story, and you don't need to write a novel here, right? It just has to have sort of a clear beginning, middle, and end, and at the end you really want to make it very clear as to how you got to what that penalty was, what you really did, and how you got to that penalty calculation that you're going to be asking for at the end of the letter for the IRS to give you. So those are kind of the big three steps. And unfortunately, in most situations, fortunately, the IRS has been very flexible and has reduced the penalty. They get back to you typically, within a short time. We'll talk about that later. But the first thing I think we should mention is that there are some other scenarios that can happen. If you do not get a response saying the penalty has been reduced, you may get what's called a letter 227. The letter 227 acknowledges receipt of the 226J response and advises on what further action the employer should take depending on what's necessary. Or you may get what's called a notice CP220J. Sounds like one of the robots from Star Wars, actually. Notice CP220J. Yeah,
or 2D2.
CP230. I don't know. So that's called a notice in demand for payment. So the notice in demand for payment is pretty serious. Like, no, we're joking around about it. That's a pretty serious deal, which that means you have to actually make a payment to the IRS that they didn't agree with your response to the letter 226J. So, Dad, you want to tell us a little bit also about how much time it takes to,
Yeah. So like we said, we've been dealing with these from the beginning, and when we were first seeing them, and like as Dan said, those low-hanging fruit ones, those easy ones, where it truly was a glitch with the checking a box no when it should have been yes. Those are easier to explain, so we really helped employers develop those letters. We sent them in. Usually within a couple of weeks they were getting a response, but this was, again, at the very beginning. Now they're getting more and more. Some of the more difficult cases where you are having to show and prove your affordability rates, where you're providing a salary and you're doing calculations to really prove that the single rate of the lowest cost plan was affordable. We had a phone call with the IRS on something else. We had asked that question, and they said, yep, we see that report, but those determinations need to be done by a tax examiner, not a general auditor at the IRS, so that those were being forwarded on. So they said usually those would take about 90 days. But obviously with the government being shut down for that month, those things were piling up. So for those of you that, you submitted the letter, I know sometimes I'll follow up with some groups and they're like, I didn't get anything, does it matter, And I'll be like, no, just good, right for now, good, no news is good news on that, and, don't panic right away, they will get back to you, on the letter. So I would say, 90 days, probably could be more these days, 120 days.
That's a good, yeah, that's definitely very true. Also, but with the government shutdown, that's a good point. Right. And I think the other thing too is that sometimes, when you spend so much time, or an organization, has spent so much time recreating the affordability analysis, right? I mean, whether that's over a holiday or a weekend or whatever it is, and you've got all the paper laying out on the table, and you're trying to recreate what actually happened and what you actually offered for that year. That can be a very long process. So once you get all of that together and you write the narrative of what happened and you send it out to the IRS, then you're just kind of waiting. You're waiting to say, okay, well, did we get the penalty reduction or not? And it can seem like forever, even though I think most of them are, like Dot said, within 90 days. But it can just seem like forever when especially if it's in the hundreds of thousands or millions of dollars of a penalty.
And I just wanted to take a step back to talk about that Dan mentioned the extension. So again, in the beginning, when there weren't as many of these issues, we did see employers, again, they called the number as soon as they got the letter. They initially got granted a 30-day waiver. And then the more complicated cases, they didn't think they were going to get done. They did call back, and they got an additional 30. But what we're seeing now is that the IRS is not being as generous with that second or third extension. So, like we said, it's always a good idea to, call and get that initial 30 days. It's helpful because if you think about situations, what if you're an applicable large employer group where you have multiple entities in different states, and what if these letters will be addressed to probably your finance person, and those letters can be sitting on a finance person's office in California. They wait 3 weeks because they don't even know what it is. They send it to you, and now you, as the benefits administrator, have to come up with a solution. You have to decide and come up and create that story. Now you have a week. So again, our recommendation always request that first extension, and then we would advise too, if you're getting close to the other, try for an additional extension. We're just not sure that it will be.
Yeah, it doesn't hurt to try, right? It doesn't hurt to try for an extra one. Now, I think that's one of the big things that distinguishes, right, the second year of compliance in round two, or strike two of the employer mandate, is that the IRS has been less flexible. We saw in the first strike, first year of letters 226J, that they were giving up to 90 days of extensions, and just kind of going back to what Dot said, right, we've only seen 30 days so far, and it's not clear that they'll go further than that 30 days. So it's more important now than ever that when that letter 226J comes in the door, that it gets sent to the right person, which, as Dot mentioned, right, it can be extremely difficult if you have a giant bureaucratic, institution, or a giant national, international organization, and it's, getting sent all around the country or the world. So definitely some good pointers there. We did also want to address some common questions that we get that we know are going to, hopefully, save us some time writing emails after this. But I think one of the things that Don mentioned earlier, right? So I don't know if we need to really kind of go into too much detail, but a lot of clients are like, well, I thought there was good faith relief, right? I thought we could get that penalty relief. And again, that good faith penalty relief just applied to the reporting penalties, which were, generally around $260 for form or for filing and for furnishing, much smaller penalties than the letter 226J employer mandate penalties, and the good faith did not extend to those. The second question, are we required to refile or resubmit our Forms 1094C with our letter 226J? Another one that we discussed actually in the program, but it's a really important one because you should always do it. The answer is a clear yes, although it's not a part of this package of materials that you're responding to, to the IRS with, definitely need to do that. And I think this third one is one that's coming up quite recently because just a lot of employers are kind of last minute trying to get their ACA information reporting done. They discover something, right? Uh-oh, I didn't do this or I didn't do that, right? And I only have, till March, whatever it is, I think March 4th to furnish, and what are we going to do?
Right, or you were working with a vendor, you had good faith in them that they submitted last year's forms, now you're starting on this year's forms, and, you start the conversation and they just happen to mention that, well, you never filed 2017 forms, so, that's definitely something you want to get back years cleaned up before you submit the current year's filings.
Exactly. And since there is that lag time between when you submit your filings and when the letter 226J comes in, right? I mean, the earlier the better. There's also reduced penalties for the reporting if it's done within 30 days or before August 1st of that year. So if, let's say you're trying to do your 2018 reporting now because you're kind of doing it kind of last minute, and you can discover a mistake, you still have that until August 1st, really kind of the last time period you have, August 1st, 2019, to really get a reduced penalty on the reporting component of that. And then do you want to talk a little bit about, I guess that's kind of related to the other question, right, about to report a mistake, can I still fix it? And our answer is yes, you should submit a corrected form or a late form if you can, if you figure out what you did wrong. Do you want to talk about the next one, the letter 5699?
So all of these letter 226Js relate to that you submitted something to the IRS and you did something incorrect or you subjecting you to a penalty. Well, the letter 5699 is a letter that you would receive if the IRS believes that you're an applicable large employer that did not submit the 1094 and 1095C. So this is a different type of response letter that the IRS is going to send you, stating, we believe you were an entity that should have reported, and now you need to, determine and calculate and figure out, should you, and make a response to that.
That's a good point. I think with this last question, I think it's pretty straightforward, but we kind of touched on it a little bit. What happens if we send a response letter to letter 226J and then never hear from the IRS at all? Now, I think it's okay to, I think if it's been 90 days, and Dot mentioned that in some cases, if it's sent to that special tax office of the IRS where they look at some, look at certain things, it could be up to 90 days. So if you go past the 90 days and you have no response, it's okay to call them. It's okay to reach out. They have a phone number. You can call them and ask about what happened and what the status is, and they usually tell you right away what it is. So.
And it appears that they have some type of database. We've been on some calls with our clients, and they were inquiring about something. It was a strange request that they were asking for. We were on the phone with them, and they called in, and we got a kind of similar to an insurance carrier. We have a different person now than the person that you spoke to earlier, but this person seemed to easily be able to pull up the conversation previously. So to Dan's point, it does look like that they are keeping track of the conversations, the correspondence, and the statuses of the letters and the response. So.
Yeah, exactly. So finally, we also wanted to mention that all of these, the forms that we've been referencing, the letter 226J and all of the forms within that, like the form 14765, the notice C23PO or CP3PO, I don't remember, 220J. So all the different types of letters that are out there that are part of this giant collection of things that you should understand are explained in the Understanding Your Letter 226J website that the IRS has, and we have a link to it here on your slides, so you can reference it after the presentation and download any of these copies of the forms and take a closer look if you'd like. So with that being said, we want to thank you for joining us here today, and we really appreciate you and the live studio audience as well. So signing off, I'm Dan Cooperstein.
And I'm Dot Summers.
Thank you.
Thank you all who attended today's show. Before you switch the channel to other programming, please take a moment to complete the brief survey that appears at the bottom so we can address any feedback you have for us. Your SHRM and your HRCI credits can now be downloaded by clicking the yellow certification button. We will send any presentation slides to you tomorrow. Thank you for your attention. We'll catch you on the next episode featuring HIPAA and cyber attacks.